Hi, my name's Ian Murray-Jones. I'm one of the in-house tax writers at Thomson Reuters. It's my pleasure to bring you the latest ClearDocs update. They say that the expression, "may you live in interesting times," is actually a sort of Chinese curse, although there's no proof for this. So I won't say that we live in interesting times, but I will say that tax-wise we are living in unusual times. Why so? Well, we had a federal election in May this year. Now, normally following an election there would be a flurry of legislation to enact all the promises that were offered on the campaign trail. For example, remember Malcolm Turnbull and the legislation for company tax rates? Well, this time is different. All the election promises are put to bed, done and dusted all over Red Rover. That is highly unusual. A bit of background. The government handed down its budget in April. It contained only two significant tax measures. One was the generous changes to the instant asset write-off rules, which were passed before Parliament rose for the election. The other measure was the personal tax cuts. This was taken to the election as the government's tax policy. The government was re-elected and legislation was then passed pretty much on the first day back. Now, I won't spend time on that other than to put up a slide as a reminder for where we stand with personal tax cuts. There it is. Look, I know it looks horrible, but you can pause the broadcast and take your time if you want to look at the details. So, for the rest of today, I want to give you a snapshot of what is happening in terms of the government's tax policy. There are roughly 7 bills currently before Parliament. The first tightens the thin cap rules and makes some minor adjustments to GST and luxury car tax. This is the annoyingly named Making Sure Multinationals Pay a Fair Share of Tax bill. As the slide shows, there are 3 components in regards of thin cap. I won't talk any more about this at this point because I'm much more excited about the next bill. But nevertheless, it is important if you have foreign-based clients. The next bill up on the slide contains 7 areas of change, of which 6 are important. And my apologies to those of you who think TOFA is important. I probably would too if I understood it better. Unfortunately, each of the measures deserves attention which I simply cannot give today. All I can do is list them, and if you recognise that they affect you or your clients, then I strongly recommend that you look at it. The first component is the avoidance measures, which will deal with assigning rights to partnership income. This has been an ongoing chestnut. The bill also contains changes affecting the following: circular trust distributions, the deductions for holding vacant land, the disclosure of business tax debt information to credit reporting bureaus, salary sacrifice rules, that is, that this does not reduce an employer's super guarantee obligations, and the implementation of electronic invoicing. Talk about a handful. The next bill also contains measures that I reckon we'll be hearing about for years to come. It is the Combating Illegal Phoenixing Bill. Again, a summary is up on the slide. There are 4 measures in it. First, the government will introduce offences to crack down on what it terms as creditor-defeating dispositions of company property. There will be civil and criminal penalties that may be imposed for company officers that fail to prevent the company from making such a disposition. But these may also be imposed on other persons who facilitate a company in doing this. Could this be you? And I'm not being facetious. Second, if the resignation of a director is reported to ASIC more than 28 days after the purported date, it will take effect from the day that it is reported to ASIC. So, no more backdating director resignations. Third, GST liabilities may be collected from directors personally. This includes anticipated GST liability. This is big in my view. If you have any clients who are struggling to get their BAS amounts due to the ATO on time, you need to familiarise yourself with the new rules. Finally, the tax office may hang on to tax refunds where a taxpayer has failed to lodge a return or provide specific information to the tax office. There are 3 other bills before Parliament which are up on the next slide. I won't discuss them now as time has got away from us. I'd like to finish though with a reminder of the very obvious. Tax is not impacted by legislation alone. Obviously, cases and rulings are hugely important. With that in mind, the full federal court has just ruled on what I thought was a very interesting matter. A summary is up on the slide. The taxpayer was an Australian resident who owned high-value assets in the US. He sold the assets, which were subject to tax in the US. He paid tax on the whole of the gains there. As an Australian resident though, the sales were subject to CGT here. The gain was discounted by 50% and included in assessable income. The taxpayer claimed a foreign tax offset under 770.10 for the full amount of the tax paid in the US. The ATO, however, contended that only 50% of the amount of US tax paid should count towards the FITO because only 50% of the net gain was included in the taxpayer's assessable income here. The Federal Court agreed in the first instance in a decision handed down last December. The full court has now dismissed the taxpayer's appeal 2-1. I reckon this case has a good chance of going up before the High Court. The dissenting decision said that Article 22 of the US-Australia DTA prevailed. In his view, the taxpayer was entitled to a credit for the whole of the US tax paid. If you have any clients who buy or sell property or assets in foreign jurisdictions, this is very much a watch this space issue. That's all we have time for today. If you've stuck with me, thank you very much. Please join me for the next session where I'll be doing some crystal ball gazing for what might be coming up on the horizon for tax in the medium term. Thanks for your time.